Welcome to TalkTickers. Net income is, well, it's an accounting illusion. Cash is reality.
That is the absolute truth.
Right. And on this deep dive, we are getting into a fundamental concept for professional financial analysis and CFA preparation. We're going to cover quality of earnings and free cash flow forecasting.
Two things you absolutely have to master.
Exactly, because we want to explore exactly why relying solely on the bottom line of an income statement is just a fast track to mispricing an asset. Or, if you are sitting for the exams, failing a vignette entirely.
Yeah, that's a trap I see all the time.
I mean, you might look at a company and see earnings per share growing at like 20% year over year, and you think you found this phenomenal compounder. But if those earnings are just a byproduct of aggressive accounting policies, you are walking into a disaster.
That's the core of the issue right there. When you look at a reported net income figure, you are essentially looking at a highly massaged theoretical number.
Theoretical, right.
Yeah, I mean, it is subject to management estimates, timing differences, and the inherent subjective flexibility of the matching principle in accounting.
Which is what we're going to unpack today.
Right. Our goal today is to break down quality of earnings, or QOE, and demonstrate how we use that rigorous analysis as the absolute foundation for forecasting free cash flow to the firm, or FCFF.
It's not just a buzzword.
Far from it. It mathematically measures the degree to which those reported earnings actually reflect sustainable underlying economic cash generation, rather than just, paper adjustments cooked up in the CFO's office.
Okay, so we're going to start with a summary of the concept and then go in depth into the theory and the practical application. We'll cover the theoretical divide between accrual and cash accounting, look at the mathematical indicators of earnings quality, and walk through a line-by-line normalization of the income statement.
And then the fun part.
Yeah, finally, we'll unpack the rigorous 8-step mechanical process to forecast unlevered free cash flow. To set the stage for all of this, I like to think of reported earnings like the shiny surface of an apple sitting under the fluorescent lights at the grocery store.
Oh, I like that.
Right. It looks perfect. It has a beautiful wax coating. But cash flow analysis is the process of picking that apple up, turning it over, pressing your thumb hard into the skin, and, checking for bruises underneath.
That's a great visual because the wax coating in your analogy is accrual accounting.
Makes sense.
And to understand why those bruises exist underneath the wax, we have to start by looking at why accrual accounting exists in the first place.
Yeah.
And why it inevitably creates this massive gap between reported income and realized cash.
Because it's required, right?
Yeah. Whether you are looking at US GAAP or IFRS standards, accrual accounting fundamentally requires revenue and expenses to be recorded when they are earned or incurred.
Not when the cash hits the bank.
Exactly. It explicitly does not care when the cash actually changes hands.
So if I can translate that to a real-world scenario, accrual accounting is essentially like promising to pay for a very expensive dinner you haven't even eaten yet.
Okay, walk me through that.
Well, you sit down at the restaurant, you order the tomahawk steak, and in the economic reality of the restaurant's ledger, a transaction has occurred.
Right, they've started cooking.
Yeah, they've earned that revenue because they are going to cook the steak. But cash accounting is the actual credit card swipe at the end of the night. Accrual accounting lets the restaurant record the satisfaction and the profit of the meal on their books before the money ever leaves your wallet and enters their bank account.
That's a perfect baseline. Now, let's look at why that system is actually necessary because, it's easy to vilify accrual accounting as just a tool for deception.
Right. People always assume it's just corporate greed.
But it's not. It is absolutely vital for projecting future performance. Let's scale up from a restaurant to, say, a company building commercial airplanes.
Okay, huge scale.
Huge. It takes years to design, build, and deliver a jetliner. If that aerospace company used cash accounting, their financial statements would look completely absurd.
Because all the cash goes out first.
Exactly. They would show massive, multi-billion-dollar losses for 3 straight years while they buy titanium and pay engineers. And then suddenly, in year 4, they would show an astronomical profit when the airline finally takes delivery and wires the cash.
Right. If you were an investor looking at those cash basis statements in year 2, you would think the company was going bankrupt.
Even though they might have a massive, highly profitable backlog of orders.
So it smooths it out.
Yes. Through something called percentage of completion accounting. It allows the aerospace company to recognize a portion of the revenue and the profit each year as they hit manufacturing milestones.
Effectively matching the economic reality of the construction process with the time period in which the work was actually done.
Right. It smooths out the lumpiness of cash flows so investors can actually assess operational performance.
But that flexibility has a dark side, doesn't it? I mean, if management is allowed to estimate how complete a project is or estimate when a customer might pay them, that introduces subjectivity.
A lot of subjectivity.
And where there is subjectivity, there is room for manipulation.
Room for manipulation is putting it mildly.
Yeah.
The academic term is earnings management, but in practice, it's often a legal, subtle form of financial obscuration.
Obscuration. I like that word.
Managers can exploit the pliancy of these accounting rules to hide extreme volatility in their actual business. They can make a terrible quarter look decent, or they can take a great quarter and squirrel away some of those profits into reserves so they have a cushion for a rainy day.
Okay, so if management can legally use accrual accounting to hide the fact that they have a cash flow problem, how do I, as an analyst or an investor, catch them before the stock tanks?
You have to look at the filings.
Right, but what am I looking for exactly?
You are looking for where the company falls on the spectrum of earnings quality. High-quality earnings are stable, they are repeatable, and most importantly, they are fundamentally backed by actual cash entering the business.
And low quality.
Low-quality earnings are volatile, they rely heavily on one-time gains, or they are driven by highly aggressive management assumptions. For instance, a classic low-quality earnings move is a company suddenly changing its depreciation schedule.
Wait, how does changing a depreciation schedule boost earnings? I thought depreciation was just, a non-cash accounting metric.
It is non-cash, but it directly impacts reported net income. Let's say a company buys a fleet of delivery trucks for $10 million.
Okay.
Under their old accounting policy, they assumed those trucks would last 5 years. That means they take a $2 million depreciation expense against their revenue every single year.
Makes sense. 2 million times 5 is 10.
Right. But let's say the CEO is under massive pressure from Wall Street to hit an earnings target this quarter, and they're falling short. The CEO can go to the auditors and say, you know what? We've improved our maintenance program. We actually think these trucks are going to last 10 years now.
Ah, I see. So instead of a $2 million expense every year, it becomes a $1 million expense.
Exactly.
They just mathematically created $1 million of extra pre-tax profit out of thin air without selling a single extra product.
Precisely. The cash flow hasn't changed by a single cent. The trucks are still out there burning gas.
Yeah.
But the reported net income on the shiny apple just got a lot bigger.
Wow.
Because accrual accounting inherently creates this divergence between paper profits and actual cash. The analyst's immediate next step must be to mathematically quantify that gap.
You can't just take their word for it.
You cannot just look at the bottom of the income statement, see $100 million in net income, and pop the champagne. You have to immediately turn to the cash flow statement and ask, did $100 million actually hit the corporate bank account?
So how do we put a hard number on that? I know there are a lot of complex models out there, but there has to be a quick back-of-the-napkin way to check if the earnings are mostly cash or mostly accounting fiction.
There is, and it's what we consider the golden rule of this entire analytical framework. It's called the quality of earnings ratio.
The QOE ratio.
Yes. It is the ultimate litmus test for earnings sustainability, and it is mathematically incredibly straightforward. You take cash flow from operations, which you find on the cash flow statement, and you divide it by net income, which you find on the income statement.
Operating cash flow divided by net income. So if a company reports $100 million in net income and their operating cash flow is $120 million, the ratio is 1.2.
Correct.
What does a ratio over 1.0 actually tell us about the business?
A ratio consistently greater than 1.0 is the gold standard. It means the company is generating more actual cash from its day-to-day operations than it is reporting as accounting profit.
Which is a good thing.
A very good thing. This signals a few highly positive things. First, it indicates high-quality earnings that are heavily cash-backed. Second, it often implies highly conservative accounting practices by management.
Like expensing things up front.
Yes, they might be aggressively expensing items up front rather than capitalizing them, which depresses the reported net income today, but leaves their cash flow completely untouched. It's the hallmark of a cash-rich, sustainably profitable business.
And I assume if the ratio is hovering right around 1.0, say 0.98 or 1.02, that's just your average, stable, mature company where the accounting profit effectively matches the cash generation.
Exactly. Nothing to worry about there.
But what happens when that ratio drops? If I run that division and the result is 0.6, what is the reality on the ground?
If that ratio drops significantly below 1.0, alarm bells should be ringing in your head. A ratio of 0.6 means that for every dollar of profit the company is bragging about on its earnings call, it only actually collected 60 cents in cash.
Ouch.
Yeah. The other 40 cents is an accounting fiction. It is tied up in non-cash assets, or it's being artificially inflated by the exact kind of management estimates we just talked about, like stretching out depreciation.
But hold on, let me push back on this because I see this all the time in the tech sector.
Okay, let's hear it.
If I am analyzing a hypergrowth company, let's say a software as a service firm that just went public, or an aggressively expanding e-commerce retailer, won't their quality of earnings ratio naturally dip way below 1.0?
Because of their spend, you mean?
Yeah, they are aggressively investing in working capital to fund that massive growth. They are hiring armies of sales reps. They are building out infrastructure. They are offering extended payment terms to capture enterprise market share. Is a ratio under 1.0 always a definitive red flag of manipulation?
That is a phenomenal question. And distinguishing between those two scenarios is exactly what separates a junior analyst from a senior analyst. And frankly, it's a massive focus on the CFA exams.
So what's the verdict?
The short answer is no, it's not always manipulation. You have to understand the difference between life cycle growth and chronic accounting manipulation.
Okay, walk me through the difference. How do I tell if a low ratio is just growing pains versus the CFO is cooking the books?
It comes down to analyzing the trend over a 3 to 5 year horizon and looking at the top-line revenue growth context.
Context is everything.
Exactly. A company in the aggressive growth phase of its life cycle will absolutely consume more cash than it generates. If a SaaS company is growing its top-line revenue at 60% a year, it is going to be burning cash to acquire those customers, extending receivables, and building out capacity.
In that specific high-growth context, a QOE ratio below 1.0 is totally expected and mathematically normal.
Because they have to spend the cash today to acquire the contract that will pay them back over the next 3 years. However, here's a critical pivot. As that company matures and its revenue growth stabilizes, say it drops from 60% growth down to a sustainable 10% growth, that quality of earnings ratio must mathematically revert to 1.0 or higher.
Oh, because the investments they made in the past should start yielding massive cash flows.
Yes. If you are looking at a mature company, one that has been public for 10 years, has saturated its market, and is only growing top-line revenue at 5% a year, and it has a persistent quality of earnings ratio of 0.7 year after year.
That is chronic manipulation.
That is chronic manipulation.
So a single year below 1.0 might just be a strategic inventory build ahead of a massive new product launch.
Yeah.
But if a boring, slow growth manufacturer is consistently reporting net income that is double its cash flow, they are systematically recognizing revenue they aren't collecting, or they're hiding expenses.
Precisely. When the QA ratio breaks down in a mature business, the culprit is almost always a mismatch in the timing of cash collections and cash payments.
The income statement says the business is thriving, but the cash just isn't showing up.
And when that happens, it forces the analyst to pivot away from the income statement, open up the balance sheet, and look directly at working capital.
Working capital. This is where the real detective work begins.
It is.
I always like to liken working capital to the plumbing of the business. Net working capital in this specific analytical context is defined as current assets excluding cash minus current liabilities excluding short-term debt.
Right. So we are looking at things like inventory, accounts receivable, and accounts payable.
Yeah. If working capital is the plumbing, then accounts receivable ballooning while cash drops means the pipes are clogged somewhere.
That's a brilliant way to conceptualize it.
The revenue water is flowing into the income statement, but it's freezing in the pipes before it actually drips into the bank account.
Let's look at the specific mechanics of how management manipulates this plumbing to artificially inflate their numbers. The first tactic is what we can call the accounts receivable trap.
Okay, lay it out.
Imagine you are a regional sales director at a publicly traded medical device company. It is the last week of Q4. You are $2 million short of your annual sales quota, which means you are about to lose your massive year-end bonus.
Oh, man. That is a dangerous incentive structure right there.
Highly dangerous and very common. So what do? You call up a major hospital distributor and you say, listen, I am going to ship you $2 million worth of surgical equipment tomorrow.
Even though they didn't ask for it.
Right. You tell them, I know you didn't order it and I know you don't need it right now, but I'm going to give you a massive discount. You don't have to pay me for 120 days. And if you can't sell it by then, you can just return it to us with no penalty.
So the equipment leaves the warehouse, and the medical device company books $2 million in revenue and the associated net income on their Q4 income statement.
Yep. The CEO gets to go on CNBC and talk about a record-breaking quarter.
Yes. But look at the cash flow. The hospital distributor hasn't paid a dime.
Not a single cent. That $2 million of supposed profit gets trapped in accounts receivable on the balance sheet.
This tactic is known as channel stuffing, or a bill and hold arrangement.
The earnings look fantastic, but the cash quality is absolutely abysmal.
So if management is playing this game, how do we catch them? I mean, we can't listen in on the sales director's phone calls.
We catch them by calculating day sales outstanding, or DSO. I want you to avoid thinking of DSO just as a dry formula. Instead, think of DSO as a stopwatch.
A stopwatch, I like that.
That stopwatch clicks start the exact moment a product is shipped to a customer and the revenue is recognized. It clicks stop the moment the customer's cash finally clears the company's bank account.
Okay, so if a company historically collects its cash in an average of 45 days, the stopwatch usually reads 45.
Right. But if you are analyzing their Q4 financials and you calculate the DSO and suddenly that stopwatch is running up to 75 or 80 days, what does that tell you?
It tells me they are turning the water pressure up so high the pipes are bursting. They are aggressively selling to customers who can't or won't pay on standard terms just to hit a revenue target.
Exactly. The revenue is recognized, but the cash is miles away.
Wow. Okay, now let's look at the flip side of the plumbing. Management can also manipulate cash flow by playing games with the drains, specifically accounts payable. Let's call this the accounts payable trick.
If channel stuffing is flooding the pipes, then playing with accounts payable is like putting a cork in the drain to keep the water level artificially high.
That's a perfect extension of the metaphor.
Let's say a company realizes their quality of earnings ratio is going to look terrible this quarter because they haven't collected enough cash from customers. They want to boost their current period operating cash flow so the analysts don't panic.
So how do they do it?
They stretch out payments to their own suppliers.
Oh, so if they normally pay their raw material vendors every 30 days, they just stop writing checks. They call the vendor and say, sorry, you're going to have to wait 90 days.
Yes. By delaying those cash outflows, the cash stays sitting in their bank account over the quarter end date.
Clever.
Very. This artificially inflates cash flow from operations for that specific reporting period. It makes their liquidity look incredibly strong on paper.
But it's an illusion.
Completely. Because that cash is already spoken for. It belongs to the vendors, and it will eventually have to leave the business.
And we track this with another stopwatch.
Correct. Days payable outstanding, or DPO. This stopwatch starts when the company receives an invoice from a supplier and stops when they finally cut the check.
So if you see DPO steadily climbing from 30 days to 60 days to 90 days, they are leaning heavily on their vendors to artificially prop up their own liquidity.
It's a short-term band-aid that eventually destroys supplier relationships.
And we can't talk about working capital without talking about the biggest physical clog in the plumbing: inventory. Let's talk about days inventory outstanding, or DIO.
Inventory is where some of the most egregious accounting games are played, particularly failing to write down obsolete stock.
Give me an example.
Let's imagine a fast fashion retailer. They manufacture a massive run of neon green winter coats, thinking it's going to be the trend of the season.
Oh boy, neon green.
Yeah, but consumers hate them. The retailer sells almost none of them. Now, they have a warehouse completely stuffed with neon green coats that have lost their economic value.
So under strict accounting rules, what are they supposed to do in that situation?
Under both GAAP and IFRS, inventory must be reported at the lower of its cost or its net realizable value. If you paid $50 to make the coat, but you can only sell it in a clearance bin for $10, you're required to take an immediate $40 write-down.
And that write-down flows straight through the income statement as an expense, which completely torpedoes your net income for the quarter.
Exactly.
So management looks at that reality and they decide to just ignore it.
They delay the markdown. They tell the auditors, no, neon green is making a comeback in the spring. We can still sell these at full price.
Right, sure they will.
By refusing to write down the obsolete stock, they keep the asset value artificially inflated on the balance sheet, and they avoid taking the expense hit on the income statement, artificially protecting their earnings.
And we use the DIO stopwatch to catch them. If DIO days inventory outstanding is climbing rapidly, it means inventory is sitting in the warehouse gathering dust.
The stopwatch starts when the code is made and stops when a customer finally buys it.
So if DIO goes from 60 days to 150 days, inventory is piling up, and a massive, painful write-down is usually imminent.
What is truly fascinating for an analyst is seeing how these working capital manipulations interlock and distort the revenue and expenses reported on the income statement.
How do they interlock?
Well, for example, a company might realize their DSO stopwatch is way too high because of channel stuffing, and they know analysts will spot it. So right before the quarter ends, they take those accounts receivable and they factor them.
Factor them, like sell them.
Yes, they sell those invoices to a third-party financial institution at a massive discount just to get a lump sum of cash in the door immediately.
Wow. So they take a haircut on the revenue just to fake the cash collection. They artificially drop their DSO to hide the channel stuffing they did in the first place.
Exactly. It's a cover-up for a cover-up.
That's wild.
And because all of this noise, all of this manipulation, and all of these timing differences exist, it leads us to a fundamental rule of valuation. An analyst cannot just take the reported EBITDA earnings before interest, taxes, depreciation, and amortization off the income statement and blindly plug it into a discounted cash flow model.
If you do that, you are modeling fiction.
You must manually reconstruct the income statement to find the true, normalized recurring profit of the core business.
Which brings us to the actual deconstruction phase. We are moving from the messy reported EBITDA to a pristine, clean figure known as adjusted EBITDA.
The holy grail.
The goal here is to strip out all the non-recurring noise. We want to find the pure baseline engine of the business running at its normal speed without any accounting tricks or one-off events muddying the waters. How do we start making these adjustments?
The mechanics of normalizing EBITDA generally fall into three key categories. The first, and most common, is adjusting for non-recurring items.
Okay.
You must completely remove the impact of one-time events that will not repeat in the future. This includes things like asset sales, legal settlements, or extraordinary gains and losses.
Give me an example of how a non-recurring item can distort the baseline engine.
Imagine you are analyzing a regional manufacturing company that makes auto parts. In year 2 of your historical analysis, they report $50 million in EBITDA, which is a massive jump from the $30 million they did the year before.
So the stock rallies.
But when you dig into the footnotes, you realize they sold an old, unused warehouse on prime real estate for a $20 million profit. That gain on the sale is sitting right there in their operating income.
But they are in the business of making auto parts, not flipping real estate. They can't sell that warehouse again next year.
Precisely. So, to find their normalized operating earnings, you must subtract that $20 million gain back out.
Yeah.
Their true recurring adjusted EBITDA is still just $30 million.
If you didn't make that adjustment and you forecast $50 million of profit going forward, your valuation model would overvalue the company by an astronomical amount.
You'd be buying a lemon.
Okay, so that's removing things that shouldn't be there. What about the second category?
The second category is run rate adjustments. This is where we adjust the historical financials to reflect a full year of a significant structural change that happened mid-year.
Okay, I think I follow.
Let's say a software company wins a massive game-changing enterprise contract that adds $10 million of high-margin recurring revenue per year. But they sign that contract on October 1st.
So their historical income statement for that year is only going to show 3 months of revenue from that new contract, just Q4.
Exactly. It will only show $2.5 million of revenue from that contract. But if you are building a model to forecast what the company will do next year, using that unadjusted historical figure is too conservative.
Because next year they'll have it for all 12 months.
Right. You need to annualize that impact. Okay. You adjust the historical EBITDA upward to reflect what the full 12 months would have looked like if they had that contract active on January 1st. You're calibrating the engine to its new current run rate.
That makes perfect sense. And the third category?
Pro forma adjustments. These are adjustments for known, measurable future changes to the cost structure, which is incredibly common in mergers and acquisitions.
How so?
Well, if you were a private equity firm analyzing a family-owned business for a buyout, you look at the current expenses. The founder CEO might be paying himself a bloated salary of $2 million a year, expensing his country club memberships and leasing 3 luxury cars through the business.
A classic small business setup.
It's very classic. But as the buyer, you are going to replace that founder with a professional CEO who makes $500,000 a year, and you're going to cancel the country club and the car leases.
Right.
Those excess costs will disappear the day you take ownership. So you add that $1.5 million difference back to the reported EBITDA. It is a known go-forward operational change that increases the true cash-generating power of the business under your ownership.
Okay, so I understand how to adjust for legitimate one-off events and future changes. But what happens when management is actively using these adjustments to deceive the market? How do we distinguish between a legitimate restructuring charge and the classic big bath scenario? Because this is something I see happen all the time when a new CEO takes over a struggling company.
The big bath is one of the most insidious and common red flags you will encounter as an analyst, and it is a favorite topic on the CFA Level 2 exams.
Let's hear the mechanics of it.
Here is how the psychology and the mechanics of a big bath work. A newly hired CEO comes into a company that has been underperforming. The stock is already down.
Okay.
The new CEO realizes that they have a free pass this year to report terrible numbers because they can just blame it entirely on the incompetence of the old management team.
Right. I inherited a mess, folks. It's going to take a year to clean up the garbage the last guy left behind.
That is the exact script. So they decide to take a big bath. They dump every conceivable future expense into the current year's income statement.
Just load it all up.
Yep. They artificially inflate restructuring liabilities. They accrue massive costs for severances that haven't happened yet. They announce facility closures, and they write down the value of assets and goodwill to aggressively low levels.
Which creates a catastrophic net loss for the current year.
It does.
But investors generally forgive it because management labels these massive charges as unusual or one-time restructuring costs. The market looks past the GAAP loss and focuses on the adjusted numbers.
Yes, but the real magic trick happens over the next 3 years. Because the new CEO took all those massive expense hits up front, the future expenses are now artificially low.
Oh, wow.
The asset values were written down so heavily that future depreciation expense plummets, and those massive severance reserves they took. If they don't actually fire all those people, they slowly reverse those reserves back into the income statement as a gain over the next few quarters.
So they basically hoarded a bunch of expenses in year one, creating a slush fund of reserves, and then they slowly bleed those reserves back into the business to artificially inflate their core recurring earnings in years 2, 3, and 4.
Exactly. It makes the new CEO look like a turnaround genius.
Yeah.
And their stock options vest at a massive premium.
That is just a total manipulation of the accrual system.
To spot this, you cannot just accept management's adjusted EBITDA figure. You have to read the footnotes. If a company is taking a one-time restructuring charge every single year for 5 consecutive years,
then it is mathematically not a one-time event.
right? It is a core operating expense that management is intentionally trying to hide below the line to make their core margins look better than they actually are.
That ties perfectly into another massive red flag I wanted to ask you about. The perfect beat.
Whoa, the perfect beat.
When you see a company that consistently hits analyst consensus earnings estimates to the exact penny, quarter after quarter, year after year.
Yes. Listen, a dynamic global business environment is inherently volatile. Supply chains get disrupted, currency exchange rates fluctuate, consumer demand shifts.
Nothing is that smooth.
If a company is posting perfectly smooth, predictable earnings growth that hits estimates to the exact penny every time, it is a statistical near impossibility. It is a blazing red flag that they are managing accruals.
How exactly do they smooth it out mechanically?
In a really good quarter, where they naturally beat estimates by 10 cents, they don't report the full beat. They intentionally over-reserve for bad debt, or they delay recognizing some revenue, squirreling away that extra 10 cents into an accounting jar. Then, in a bad quarter, where they are going to miss estimates by 10 cents, they reach into that jar. They reverse the reserves, or they pull forward some revenue through channel stuffing to plug the hole.
So they're constantly netting one-time gains against operating expenses to completely hide the natural volatility of their actual business from investors.
Exactly.
Okay, so up to this point, we have learned how to spot the illusion of net income. We've used the quality of earnings ratio to identify if there's a cash problem. We've checked the working capital plumbing with our DSO, DPO and DIO stopwatches to see exactly where the cash is getting trapped.
We've done a lot of cleaning.
And we've stripped out the big baths and the real estate sales to calculate a clean adjusted EBITDA. We've finally found the true baseline engine of the business.
And that normalization process is absolutely mandatory because once an analyst has that clean adjusted EBITDA and they have established the true recurring working capital needs of the business, they finally have the reliable inputs required to actually forecast future cash flows.
Because building a discounted cash flow model on a foundation of manipulated unadjusted earnings is worse than useless.
It will yield a completely fictitious valuation that gives you a false sense of precision.
Which perfectly sets up the mechanical core of this entire deep dive. The rigorous 8-step process for projecting free cash flow to the firm, or FCFF.
Let's get into it.
I always compare building an FCFF model to assembling a high-end mechanical watch.
Okay, I like that.
You have all these tiny gears: revenue growth, tax rates, working capital, depreciation. If your assumption for capital expenditures is off by just a fraction of a millimeter, it grinds against the property, plant, and equipment gear, which causes the depreciation gear to slip.
Yep.
And suddenly the final free cash flow time you read on the dial is completely, hopelessly wrong. Every single step has to interlock perfectly with the operational reality of the business.
That is the exact right mindset for financial modeling. It must be mechanically sound. So let's walk through those 8 interlocking steps methodically and identify exactly where most junior analysts and CFA candidates make catastrophic errors that blow up their models.
All right, let's open up the watch. Step 1.
Step 1 is gathering historic financials and setting your forecast horizon. You need 3 to 5 years of the clean, normalized historical data we just spent all this time constructing.
Got it.
Your forecast horizon, how far into the future you are going to explicitly project these cash flows, is typically 5 to 10 years. But that number isn't arbitrary. It must be dictated strictly by the company's life cycle and competitive advantage.
Right, because you can't explicitly forecast a company's cash flows out for 50 years. Eventually, you have to cut it off and calculate a terminal value, which assumes the company just grows at a steady, boring macroeconomic rate forever.
Exactly. So if you are modeling a mature, stable utility company, you might only need a 5-year explicit forecast before you calculate terminal value. Their growth is already stabilized.
What about a tech company?
If you are modeling a high-growth tech company that is currently expanding at 40% a year, you must use a 10-year horizon. You need those extra 5 years to logically allow its massive growth rate to slowly decay down to a sustainable terminal rate of 2 or 3%.
If you cut a hypergrowth company off at year 5, your model will drastically undervalue it.
Completely.
Makes sense. Step 2 is where we start doing the math. Calculating historical NOPAT net operating profit after taxes. Now, I know there is a massive trap here regarding taxes. How do we calculate this without falling for an accounting illusion?
NOPAT is your normalized operating profit minus taxes. But the critical nuance for real-world modeling and a very common trick on the CFA exams is how you handle the tax line.
What's the trick?
You take your normalized EBIT earnings before interest and taxes, but you must subtract the actual income taxes paid in cash. You do not just apply a theoretical effective tax rate to the book income.
Why not? If the income statement says their tax rate is 21%, why can't I just multiply EBIT by 0.21?
Because the tax expense reported on the income statement, the book tax includes deferred taxes. Deferred taxes are non-cash accounting entries created by differences between GAAP accounting rules and IRS tax codes.
Like depreciation differences.
For example, yes, the IRS might let a company accelerate the depreciation of an asset to lower their cash tax bill today, but GAAP requires straight-line depreciation for the public filings. This creates a temporary difference.
Okay.
We are building a cash flow model. We don't care about theoretical accounting tax brackets. We want to know the real hard cash that was wired to the government. So we use cash taxes actually paid.
Got it. Keep it tied to the cash. Step 3 is forecasting revenues. Now, a lot of people just look at the last 3 years, calculate a compound annual growth rate, say 15%, and just drag that cell to the right in Excel for the next 10 years.
Yeah, that is a terrible idea.
I assume so.
It's the mark of a lazy analyst. You cannot just straight-line historical growth. You must build fundamentally driven, conservative, base, and optimistic cases.
Because things change.
Exactly. If historical revenue grew at 15%, but you know the industry is maturing, or new competitors are entering the market, Your base case might slowly decay that growth down to 5% over the forecast horizon.
And you don't just guess those percentages. You tie them to macroeconomic drivers, projected unit volumes, and the company's pricing power.
Right. If they sell coffee, you forecast how many cups they will sell and how much they can raise the price of a cup each year given inflation.
Step 4 is forecasting cost of goods sold, or COGS, and operating expenses, like SG&A. How do we mechanically tie these expenses to the revenue we just forecast?
Here, we typically use the percentage of sales method. You look at your normalized historical margins.
So if COGS has reliably been 40% of revenue and SG&A has been 20%, you apply those historical percentages to your new forecasted revenues.
Yes, however, again, you have to apply human judgment. This is where you model operating leverage.
Operating leverage meaning as a company gets bigger, it doesn't need to hire a new HR person for every new dollar of sales, so the fixed costs shrink as a percentage of total revenue.
Exactly. If the company is scaling rapidly, you should assume they gain operating leverage. Maybe SG&A starts at 20% of sales in year 1, but slowly drops to 18% by year 5.
And that small 2% margin expansion will have a massive compounding effect on your final valuation.
Huge effect.
Okay, now we reach step 5, which is the fixed asset schedule. And I know from experience, this is the gear in the watch that most commonly breaks.
Oh, absolutely.
This is forecasting depreciation and amortization and capital expenditures. What is the fundamental rule here?
The fundamental rule is that you must forecast depreciation and CapEx as a percentage of beginning property, plant, and equipment, not as a percentage of sale.
Wait, really?
Not
sales.
All right. Many junior analysts just say, well, CapEx is usually 5% of sales, so I'll just keep it there. That is mathematically catastrophic.
Yeah.
CapEx is tied to the physical asset base required to generate future capacity, not the current sales figure itself.
Explain how that breaks the model. Give me a concrete example of why tying CapEx to sales destroys the math.
Let's use a software company that relies on massive server farms.
Okay, good example.
You forecast that their sales are going to grow aggressively at 30% a year for the next 5 years. If you blindly tie CapEx to that 30% sales growth, your model is going to assume the company is spending an exponentially massive amount of cash buying new server farms every single year.
But servers don't work like that.
Exactly.
Yeah.
You build a massive data center once, and it provides enough capacity to support sales growth for the next 5 years without needing another massive cash outlay.
Right.
If you tie CapEx to sales, your CapEx will spiral out of control. Your asset base will mathematically explode to an unrealistic size, and your model will say the company's burning so much cash, it will go bankrupt.
So how do we lock the gears together correctly?
You must lock in the standard roll-forward formula. Beginning PP&E minus depreciation plus capital expenditures equals ending PP&E.
So it flows naturally.
Yes. You forecast CapEx based on the strategic needs of the physical asset base. You forecast depreciation based on the useful life of that expanding PP&E balance. This ensures your balance sheet balances logically and that your asset base realistically supports your revenue forecast without mathematically exploding.
That is so critical. The physical assets dictate the capacity. Okay, step 6 brings us back to our working capital plumbing, the non-cash net working capital schedule. This is where we forecast future accounts receivable, inventory, and accounts payable. I'm guessing we don't just tie these to a flat percentage of sales either.
Correct. You forecast them using the exact stopwatches, the DSO, DIO, and DPO days that we calculated during our quality of earnings analysis. You project what those days will be in the future based on management's operational plans.
So if we determine the normalized DSO for our company is 45 days, how do we turn that day's metric back into a dollar amount for the balance sheet in year 3 of our forecast?
It's the reverse of the stopwatch formula. You take your forecasted revenue for year 3, you divide it by 365 to find your daily revenue, and then you multiply it by the 45 days.
That converts the days back into a forecasted dollar amount for accounts receivable.
You do the exact same process for inventory using forecasted cost of goods sold and DIO, and for accounts payable using COGS and DPO.
That's elegant.
This methodology rigidly respects the operational reality of the business's cash conversion cycle. It prevents you from forecasting massive revenue growth without accounting for the massive amount of cash that will get sucked into working capital to support it.
Which brings us to the grand finale, steps 7 and 8. The final FCFF calculation. This is the waterfall where all the gears finally interlock to give us the time on the dial, Walk us through the final formula.
You start at the top with your forecasted NOPAT net operating profit after taxes. This is your unlevered cash tax adjusted operating profit. Then you add back your forecasted depreciation and amortization.
Because D&A is a non-cash expense, it reduced our NOPAT, but we didn't actually write a check for it this year, so we add that cash back into the pool.
Exactly. Next, you subtract your forecasted capital expenditures. We subtract it because this is actual hard cash leaving the business to buy new physical assets, upgrading software, building warehouses, buying trucks.
And finally, the plumbing check.
Finally, you subtract the change in non-cash net working capital. You look at the working capital balance you forecasted for year 2 and subtract year 1.
Okay.
If net working capital increased by $10 million year over year, meaning accounts receivable, inventory grew faster than accounts payable, that means the plumbing consumed $10 million of cash to fund operations. So you subtract that change from your cash flow.
And what does that final number actually represent? What is the philosophical meaning of free cash flow to the firm?
That exact sequence, NOPAT, plus D&A minus CapEx minus the change in non-cash working capital yields your unlevered free cash flow to the firm. It is the holy grail of valuation.
The holy grail.
It represents the actual unadulterated discretionary cash generated by the core operations of the business that is freely available to be distributed to all capital providers, both debt holders and equity investors, before a single cent of interest or principal is paid.
And that stream of cash flows is what you discount back to the present value to find the intrinsic value of the entire enterprise.
Exactly.
Now, knowing the mechanics of this 8-step model is great, but it's purely academic unless we understand how these precise adjustments change valuations in the real world and how they appear to trip you up on the CFA exams or in a private equity bullpen. Let me ask a pushback question that I hear all the time from people learning valuation.
Right.
If thousands of institutional analysts at massive hedge funds are all running these complex QOE adjustments, isn't the market already perfectly efficient? Isn't the adjusted EBITDA already priced into the stock?
It's a fair question.
I mean, why does an independent buy-side analyst need to build this from scratch if it's already sitting in the consensus estimates on a Bloomberg terminal?
That is the trillion-dollar question. The answer is that consensus estimates are heavily influenced by management's biased narrative.
Biased narrative.
Wall Street analysts often rely on the heavily massaged non-GAAP figures that management spoons feeds them during earnings calls. Management will tell the market what they believe their adjusted EBITDA is, and they will conveniently exclude massive, very real expenses, like stock-based compensation.
Right.
Or they will treat recurring legal fees as one-time expenses to make the core business look wildly profitable.
So if you just trust the street consensus, you're basically buying the wax-coated apple without checking it yourself.
Exactly. The true alpha, the real edge for a buy-side analyst, comes from independent normalization. You don't trust the consensus. You dig into the footnotes yourself. You find the aggressive capitalization of R&D expenses that management used to inflate current net income.
And you reverse it.
You reverse it. You find the true lower economic earnings. You run your own 8-step FCFF model based on conservative working capital stopwatches. And because your independent model reflects reality, you avoid buying into a massive value trap that the rest of the market is blindly pouring money into.
This independent verification is incredibly visible in the real-world mergers and acquisitions market, especially in the lower middle market where companies aren't heavily audited by Wall Street.
Oh, absolutely.
If you are a private equity firm valuing a private business for an acquisition, a formal quality of earnings report completely alters the deal multiples. Private companies that go to market without a formal third-party QOE report historically trade at significantly lower multiples, say 4.2 times EBITDA, than identical companies that have a verified QOE report, which might trade at 5.1 times EBITDA.
And the reason for that multiple expansion is simple. Uncertainty demands a discount.
Accept.
If the buyer cannot independently verify that the earnings are cash-backed, sustainable, and free of channel stuffing or delayed inventory write-downs, they will drastically lower the purchase price to protect themselves against the risk of buying an accounting fiction.
And for those of you sitting for the CFA exams, you will constantly be tested on detecting these specific accounting policy changes and adjustments in complex vignettes.
Constantly.
One of the classic scenarios is spotting a company that suddenly shifts from LIFO to FIFO inventory accounting during an inflationary environment. Explain the mechanics of why management would do that to trick investors.
Let's use a very physical analogy to understand the how and why of LIFO and FIFO. Imagine a giant pile of gravel sitting in a hardware store's yard.
Okay, a gravel pile.
Because of inflation, the gravel at the bottom of the pile, which the store bought in January, was cheap. The gravel at the very top of the pile, which the store bought in December, was very expensive.
Okay, LIFO stands for last in, first out. FIFO is first in, first out.
Right. If the store uses LIFO accounting, it's like taking a shovel and scooping gravel off the very top of the pile to sell to a customer. They're matching the most recent, most expensive inventory costs against their current revenue.
Which results in a high cost of goods sold and mathematically lowers their reported net income.
Exactly.
Which is bad for the shiny apple, but great for reducing their tax bill. But what if they want to inflate earnings?
If the CEO wants to artificially boost earnings to hit a target, they switch to FIFO. Now it's like taking a shovel and scooping gravel from the very bottom of the pile. They are matching the old, cheap January costs against today's revenue.
Wow. This artificially lowers their cost of goods sold and creates a massive instantaneous boost to their reported net income.
The physical gravel didn't change. The cash collected didn't change. But the accounting profits skyrocketed.
And on the exam, you will be given a vignette where a company does exactly this, and you will be asked to manually adjust their financials back to LIFO to accurately compare them with a peer group that didn't change their accounting.
You'll see it every time.
You will also be tested heavily on related party transactions. This is where a company sells assets or inventory to an entity that is secretly controlled by the CEO or a board member at massively above market prices.
Yeah, they use these shell entities to funnel cash and create artificial revenue.
You must be able to spot these transactions in the footnotes because they are not at arm's length, they do not reflect true market demand, and they absolutely cannot be counted as sustainable recurring earnings in your FCFF model.
This integration of strict accounting theory and ruthless real-world application leads us to our final takeaway. We've talked about the accrual illusion, the golden QOE ratio, the working capital stopwatches, the deconstruction of EBITDA, and the precise mechanical gears of the free cash flow model.
We've covered a lot of ground.
But the ultimate filter for any financial model you will ever build boils down to one simple ethos.
Cash is fact. Earnings are an opinion. Your discounted cash flow model, no matter how beautifully formatted it is in Excel, no matter how elegant your terminal value calculation is only as good as the normalized inputs you feed into it.
If you feed the model manipulated net income, it will systematically spit out a manipulated valuation.
You cannot take shortcuts. You must deconstruct the income statement line by line. You must remove the non-recurring noise, reverse the aggressive accounting assumptions, check the stopwatches on the balance sheet, and anchor your entire 8-step forecast strictly on the operational reality of the cash flow statement.
If you do not perform a rigorous quality of earnings analysis before you start forecasting, you are flying blind into a storm.
Which brings us to the one question. When you're looking at a management pitch deck, reading a glowing earnings release, or grinding through a brutal level 2 vignette, this is the single punchy question you must always ask. If this company is so incredibly profitable, where exactly is the cash?
Because if net income is skyrocketing to the moon, but operating cash flow is flat or declining, the earnings are an accounting fiction, and the intrinsic value you think you found is a mirage.
Keep picking that apple up, keep turning it over, keep pressing your thumb into the skin to find the bruises underneath the wax. That is how you find the truth in financial analysis. Thank you for joining us on TalkTickers. Keep digging, keep questioning, and we will see you next time.